Hello everyone, my name is Karan Sehgal and welcome to the training session of IFRS 15, Revenue from Contract with Customers. In today's session, we're going to cover step 5, that is, determine when to recognize revenue. The concept we will cover today would be on transfer of control, performance obligations satisfied over the time. How do we measure in case the performance obligation is satisfied over the time, that is, on the basis of input method and output method, performance obligation satisfied at a point in time, different concepts like customer acceptance, consignment arrangements, and bill and hold transactions, and case studies which will help us to understand all these scenarios in a better way. In this slide, we will cover the overview of step 5, how to determine when to recognize revenue. Revenue is recognized as and when the entity satisfies the performance obligation by transferring promised good or service to the customer. A good or service is transferred when or as the customer obtains the control of it. At the inception of the contract, the entity needs to determine whether it would transfer the performance obligation at a point in time or over the time. If it is determined that the transfer happens over the time, then the entity needs to select an appropriate method to measure the progress. As stated earlier, the good or service is transferred to the customer when the customer obtains control of it. Control refers to the customer ability to direct the use and obtain substantially all the remaining benefits from the asset. It also includes the ability to prevent other entities from directing the use of and obtaining the benefit from an asset. Each potential cash flow that are obtained directly or indirectly are the benefit of an asset. The new standard is based on control-based model, assessing the transfer of goods or services by considering when the customer obtains a control may result in different outcomes and therefore significant difference in timing of revenue recognition. The new standard extends a control-based approach to all the arrangement, including service contracts. Performance obligation satisfied over the time. For each performance obligation in the contract, an entity first determines whether the performance obligation is satisfied over the time, that is, control of good or service, transfers to the customer over the time. It is done by using the following criteria. First, the customer simultaneously receives and consumes the benefit provided by the entity's performance as the entity performs, and the another entity need not substantially reperform the work already completed. The entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. The entity's performance does not create an asset with any alternative use to the entity, and the entity has an enforceable right to the payment. If any of the conditions are met, then revenue is recognized over the period of time. The next step is to select a method to measure the progress. The entity applies a single method to measure the progress towards completing satisfaction of performance obligation. The objective is to depict the transfer of good or service to the customer. Let's look at a case study to understand the concept of performance obligations satisfied over time in a better way. A enters into a contract with B for clearing and maintenance services. In case of clearing and maintenance services, the consumer will simultaneously receive and consume the benefit of the service. In case a new entity replaces A, it need not perform the clearing services already completed by A. As the first criteria of satisfaction of performance obligation over time is met, which was the customer simultaneously receives and consumes the benefit, and the other entity need not substantially reperform the work already completed. This is a scenario of revenue over time. Let's look at another case study. A enters into a contract with B to build a software. This software is specifically for B to meet its business requirement. As per the terms of the contract, A has a right to payment once the software has been completed and tested with B. In the above scenario, the first criteria is not met as B would not simultaneously receive and consume the benefit. The second criteria is also not met as the control would be transferred when the software has been completely built. As per the third criteria, A builds an asset which does not have an alternative use as it is made specifically to meet the business requirement of B. However, A has a right to payment only when the software has been completely built. As all the three criteria are not met, revenue would be recognized in this case at a point in time. Now, considering the same example, if A had a right to payment for all the cost incurred plus a margin of 20%, then the third criteria would have been fulfilled. The third criteria was the entity performance does not create an asset with alternate use to the entity and the entity has an enforceable right to the payment. So if the entity was collecting or entity had a right to payment, then the revenue would have recognized over the time. Once the entity determines whether the revenue is recognized at a point in time and over the time, the next step is, in case the revenue is over the time, how would the entity measure the progress? There are two methods to measure the progress: output method and input method. Output method is based on the direct measurement of value to the customer of good or service transferred to date relative to the remaining good or services promised under the contract. Few examples are milestone payment, time-based payment, survey of performance to date, appraisal of results achieved. Input method. Input method is based on the entity's effort or inputs towards satisfaction of performance obligation relative to the total expected inputs to satisfaction of performance obligation. Examples are resources consumed, cost incurred, time elapsed, labor hours expended, machine hours used. An entity recognized revenue over time only if it can reasonably measure its progress towards complete satisfaction of performance obligation. However, if the entity cannot reasonably measure the outcome but expects to recover the cost incurred in satisfaction of the performance obligation, then it recognizes revenue to the extent of the cost incurred. The new standard requires an entity to select a method that is consistent with the objective to depict the transfer. An entity does not have a free choice in selecting the method. The other point to keep in mind is that only a single method can be used to measure a progress for each performance obligation. An entity applying an input method excludes the effect of any inputs that does not depict its performance in transferring control of good or service to the customer. The entity needs to adjust for incurred cost that does not contribute to an entity's progress in satisfaction of performance obligation, like wasted materials, labor hours, or cost that is not aligned with the entity progress in transferring good or service to the customer. Let's look at a case study to understand the concept of input and output method. A enters into a contract with B to transfer a specialized printing machine. The machine is normally used by the IT companies. The contract value of the machine is $1,500. The expected cost to be incurred is $1,200. A is expected to incur a high cost in the initial period of contract, and the expenses are expected to reduce in the later stage of the contract. This is because most of the expenses could be wasted materials due to the learning curve of the entity. The duration of the contract is 1 year. In this case, if the entity uses the percentage of cost method to measure the progress, it won't depict the correct picture of transfer of control to the customer, as it is expected that the entity would incur high cost upfront. In such cases, entity needs to exclude the input that does not depict the transfer of goods or services. If a performance obligation is not satisfied over time, then it is satisfied at a point in time. The entity needs to assess and determine when the control is transferred to the end customer. There are few indicators which should be assessed whether the control is transferred or not. The entity has a right to payment for the asset. If the customer is obliged to pay for an asset, this is one of the indicators that the control is with the customer. The customer has a legal title to the asset. The entity has transferred the physical possession of the asset. The customer has a significant risk and reward of ownership of the asset. The customer has accepted the asset. Now, all the above points are indicators which should be assessed to determine whether the control is transferred or not. Customer acceptance. Many contracts have clauses around customer acceptance. Customer acceptance clause allow a customer to cancel a contract or require an entity to take remedial action if a good or a service does not meet agreed specification and should be considered when evaluating when a customer obtains control of goods or services. If the entity has objectively determined that the control has been transferred to the customer in accordance with the agreed specification in the contract, then acceptance criteria becomes a formality and revenue is recognized once the control is transferred to the customer. If the entity cannot objectively determine whether the agreed specification in the contract are met or not, then it needs to obtain an customer acceptance certificate. Till that time, revenue needs to be deferred and recognized only when entity has a formal acceptance from the customer. Let's look at an example or a case study to understand this concept. A enters into a contract with B to transfer a specialized machine. As per the terms and conditions of the contract, A needs to deliver the machine to B's premise, install the machine, and perform a test with a team of B's engineer. A would also need an acceptance certificate from B stating that it is satisfied by the performance of the machine and the machine has been perfectly installed. In this case, control would be transferred to the customer once the acceptance certificate is collected by A because this requires a formal acceptance from the customer. Consignment arrangements. When the entity delivers the product to the third party for the sale to the end customer, the entity needs to determine whether the control of the product is transferred to the third party or not. It may be possible that the third party is holding the product on behalf of the entity. The following indicators should be considered to determine whether the control is transferred or not. The product is controlled by the entity until a specific event occurs, such as sale of the product to the end customer. The entity can require the product to be returned or transferred to a third party. There is no unconditional right of payment by third party to the entity. If it is determined basis the above clauses that the control is not transferred, then the transaction need to be accounted as a consignment arrangement and revenue to be recognized when the product is sold to the end customer. Bill and hold transactions. There can be scenarios where the entity bills the customer for a product when the delivery is not made and the physical possession is retained by the entity. Under such scenarios, entity need to assess whether the control has been transferred to the customer or not. There are few factors which needs to be considered. Firstly, entity needs to determine whether the customer has the ability to direct the use and obtain substantially all the benefits from the product even when it is not in the possession of the asset. This would help entity to determine whether the customer controls the product or is it acting as a custodian. The other factors are as follows. There needs to be a reason for a bill or hold transaction. The product must be identified separately as belonging to the customer. The entity doesn't have the ability to use the product or direct it to any other customer. The product must be ready for physical transfer to the customer. If it is determined that the entity controls the product, then it would be accounted as a bill and hold transactions and revenue to be recognized in the future date, that is, when the control is transferred to the end customer. This brings us to the end of this session where we covered step 5, that is, when do we actually recognize the revenue. Stay tuned for the next session. Until then, goodbye.